This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
This is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we will provide you in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we're going to take a look at the chances of a spot Bitcoin ETF this year, and are higher interest rates boosting the appeal of used aircraft over new ones. But first, recent ESG developments are hitting the bottom line across industries as low water levels and fires disrupt marine shipping and labor relations with pilots impacting airlines. For more on this, we are now joined by Bloomberg Intelligence Senior ESG Integration Analyst Gail Glazerman. Broad stroke, there's been a ton of pushback on ESG in recent months. How do you think that evolves?
I think it changes behavior at companies and investors for the better, but I also feel a lot of it is missing the mark. A lot of the pushback that you hear seems to think that there are sacrifices made to pursue ESG strategies and that these are things that are in conflict with fiduciary duty. But the reality is, for a lot of issues, for a lot of companies, there are very, very tangible financial impacts that can be billions, if not jeopardizing entire business models. Now, it's not every issue being relevant for every company, which is part of the problem that the industry's dug itself into. But I think as managements talk more explicitly about the things that really are relevant and tangible for their businesses.
And that, to the point, kind of goes to the water levels that I had referenced, right? So you have the E, drought, environmental stuff, right? And then you have social, so let's talk about the labor pressures. And then you wind up having governance like fines. Can you draw the lines between like, look, you guys really have to pay attention to these things because it actually has a material impact, and here's the number that shows it?
Yeah, absolutely. So just think back a year or two with all the supply chain disruption that we saw recovering from COVID. And then just think about a pressure point like the Panama Canal, where at least, I believe, 40% of U.S. shipping goes through, having serious backlogs because Panama, one of the wettest countries on earth, is having a serious drought. So talking through the financial implications of that. Anyone shipping goods is going to all of a sudden have uncertainties because you're going to have to wait longer. Or there was just a news story today that the Panama Canal Authority is auctioning off faster transit. So you're going to have to pay a lot more. Or you might have to go around, which is going to add a lot of time and, again, creating uncertainty. And, obviously more tangibly, if you're issuing debt for the Panama Canal and you have issues, that's an issue. There's also capital requirements where they're looking, I believe, to build more dams and have greater protections in the future. So that's just one example. Another example, it's not the only place we've seen drought impacting shipping. Europe, river shipping, I believe, is something like an $80 billion industry.
And water levels, that's what I live for.
Exactly. So in 2018, it cost about $5 billion, I believe. And the industries that use the rivers at least started to learn their lessons. So now they're investing in barges that can actually move at lower water levels. And obviously that comes at a cost, but over the long term, less of a cost than having to find completely new ways to get your goods to market or your raw materials to your factories.
So the other part, so in some ways that's a little bit more tangible. I feel like it's the social stuff that I think gets people really confused and investors on how to value something, like what that actually even means.
Absolutely. And again, it's not every issue for every company, which is where I feel some of the confusion came.
Because it's not uniform.
Exactly.
Right.
Different issues for different companies. So if you think about something like airlines, thinking back to last year, disruptions, delays, cancellations because of labor shortages. So what happened is labor got a lot more power. Companies started to realize the significance that labor isn't just an interchangeable product. And you're starting to see things like contract renegotiations that are adding 10, 20, 30% to compensation. So American Airlines last week, their pilots ratified a contract, and I think it has, over the life of the contract, roughly $9 billion. And one of the more interesting elements of that is I think about 20% of that was kind of non-direct financial compensation, which is a big trend I think we're seeing coming out of it, which is more vacation time, better, more flexibility on scheduling, and I believe even more access to first-class seats on planes, which then takes away a product that could affect frequent flyers.
Oh, interesting. I didn't know that. That's where you make your money, front end of the plane.
Yeah, and I mean, at the very least, it attracts frequent flyers who at least might be loyal to your airline for having a chance of getting it, even if you're not paying directly for that seat. So it's just one example. The rail negotiations from late last year, the big sticking point was, again, sick days. So there were hefty compensation changes, but it was also scheduling quality of life. And I think that's one thing that's really come out post-pandemic.
Great stuff. Really appreciate it. Gail Glazerman, Bloomberg Intelligence Senior ESG Integration Analyst. All right, let's turn now to the very popular QQQs. If you're kind of trading tech, this is the thing you know. It's the Invesco QQQ ETF. It's dominated broad market index ETF investing for the past 15 years. But is there something actually better that's done better? I feel like that's a little bit of heresy, but let's get into it. Bloomberg Intelligence Mutual Funds Analyst David Cohne. Hey, David, really? Is there something that beats the QQQs?
Yes, there actually is.
What?
One mutual fund that's been able to outperform the Qs over 5, 10, and 15 years. It's the Barron Partners Fund.
What is that? I've never heard of this before.
It does have a good amount of assets, so it's not a fund that's known, that no one's ever heard of. It's not a huge company. It's not part of, a giant fund company like Vanguard or Fidelity, but it's a small fund shop that, has a good amount of assets. And this particular fund is a very concentrated fund. I believe as of its most recent holdings they published, it was about only 20 stocks, and they actually had a 40.5% allocation to Tesla. So they're basically taking on more risk with a concentrated portfolio and making the right picks. And, so far they've been able to outperform the QQQ over different time periods, which no other fund can say.
What are the 20 stocks? So if like half of their investment then is in Tesla, what are the other 19 stocks?
I know. Before I want to get into the other stocks, I do want to mention they actually have private allocations to SpaceX and a small allocation to X, formerly known as Twitter.
So it's really a very big Elon Musk bet.
Yeah, managers Ron and Michael Barron definitely have an Elon Musk bet. It takes up half the portfolio. And the rest of the stocks, they've got an allocation to Hyatt Hotels, Vail Resorts. It's a bunch of different other types of stocks, Arch Capital Group. And the thing with this fund is it's not really held into, say, large growth or mid-value or something like that. It's almost as if it's a go-anywhere equity fund. And I think that's one of the reasons why they've been able to outperform the Q is they're not kind of beholden to a lot of things. And they're also a non-diversified fund, which means they can have this concentrated portfolio.
So this may be a very silly question, but how often does a fund like this change its holdings and allocations?
It really depends. I mean, a fund like this, it doesn't appear that they trade too often, but, the Tesla holding has grown over time. So they've actually held this for, believe at least 5 years, and it's basically they've let it grow over this time. And if you go back 10 or 15 years, it's not Tesla that's making up a large percentage of their portfolio, it's other stocks. And so I think the thing that they've done is historically and consistently just held concentrated portfolios, and it's really Tesla that's driven their performance over the past few years.
I totally wonder what the macro signal is from that, to be perfectly honest. So I understand it beats the QQQs, and QQQs have been obviously a stellar performer. What about the SPY, the SPY? Clearly that's underperformed the QQQs, but I'm just wondering how that stacks up and what kind of the return numbers are.
So the SPY has returned, it's 11% over 5 years. And if you're comparing that to the Qs have returned 17.6% over 5 years. And Barron Partners has returned 27.2% over 5 years. And these are annualized numbers.
Oh, wow. How come I don't know about this?
I just don't think they have the marketing budget that some of the giant firms have. And I think the other thing is, it's a fairly decent-sized fund, but if they had a huge amount of assets, I think they'd have a hard time managing this type of portfolio if they were a giant fund.
Right. It's sort of like the law of large numbers.
Warren Buffett once said that if he had $1 million, he could turn that portfolio around over and over again. And it's a lot easier when you have a smaller asset base to really grow.
So that's one Barron fund. Does Barron have other funds that have also done well?
Yes. The Barron Focused Growth Fund is another fund that they manage, and this actually has a pretty similar portfolio to the Barron Partners Fund. Their top holding is Tesla. It doesn't have a 40% allocation, but it does have a 14.9% allocation. And guess what the second holding is?
Tesla?
SpaceX.
SpaceX. Excellent. Okay, fair enough.
And so same thing. Other big holdings are Arch Capital and Hyatt Hotels, and so this is just a slightly different fund that has somewhat of a similar portfolio. But this fund is really more focused on the small and mid-sized growth companies. Although I wouldn't consider Tesla a mid-sized or small company. But once again, it's a company that the managers let grow in their portfolio.
Great stuff. Really, really interesting. David Cohne, really appreciate it. Bloomberg Intelligence mutual fund analyst. All right, coming up on the program, older aircraft appeal is soaring and higher interest rates may be the cause. You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Higher interest rates could also be a strong headwind for new aircraft demand, and last-generation price declines have now tilted the playing field firmly in their favor. Let's get more on this. Bloomberg Intelligence senior aerospace, defense, and airlines analyst George Ferguson joins us now. George, when I think of higher rates and sectors impacted, I got to be honest, airlines isn't the one that I think of. What is the relationship between higher rates and then aircraft demand?
Typically airplanes can be financed. Not even typically, and
they are.
During normal times, they're financed a lot, right? Mm-hmm. Post pandemic, what we've had is we've had a lot of airlines that had cash on their balance sheet. A lot of them put cash on during the pandemic as as protection in case operations got more unstable and they were burning too much cash. So they took out a lot of debt at low rates, right? This is pandemic era rates before we saw them really tick up as the pandemic was ending. And they left the cash on their balance sheet. And we've seen lots of airlines, especially U.S. airlines, take some of this cash and deploy it on new airplanes. Mm. But prior to the pandemic, anytime an airline was buying an airplane, they would have to look at sort of cash on hand and look at the financing markets and figure out what the best avenue was for funding the airplane purchase. And many times it was either via a lessor or a double ETC, which is the Enhanced Equipment Trust Certificate market. It's essentially a bond market, and the bonds are backed by the airplanes purchased by the airline. Those rates in the double ETC market, pre-pandemic, we were talking for seniors, we were talking rates that were in the 2% and 3%. Mm-hmm. And recently, United came to this market because United is going to add, it's one of the airlines that's going to add the most to their fleet during 2023 and 24. They've got a big fleet refresh going. They had to come to market. The seniors were 5.8%. So it's like a 300 basis point move in that market. And that's pretty significant when you start to think about, what the return is from putting a new airplane in your fleet.
Does that mean that used planes are a better option then in this environment?
Yeah, so we published a piece this week where we looked at the trade-off between a new and used airplane. And we essentially took a brand new Airbus A320neo or a Boeing Max 8, which is sort of the most popular of those two narrow-body airplanes. They're the biggest component of airline fleets around the world. And we looked at the new price for those, which are in the low 50 millions. And we looked at a used price for an airplane like the A320ceo, which is the predecessor to the Neo, and the Boeing 737NG, they call it next generation, dash 800. And so, right now, the used price for those two, the Boeing's a little more expensive. Mm-hmm. It's about $20 million. And the CEO, the Airbus A320ceo, is about $18 million. And so we looked at the difference in purchase price, and we compared that difference, the cash flows in purchase accounting. And we also compared the fuel differential in operating those airplanes, right? And so the Max and the Neo, the current generations, are 15% more fuel efficient than the older generation airplane. And what falls out of our model is that the higher interest costs, because of that 5.8% EETC that United issued this year, that's what we used as our benchmark, the higher interest costs more than overtake the fuel efficiency.
Interesting.
And if you look at the price, again, of sort of owning and operating both of those two airplanes, if you were an airline and you're saying, hey, it's day zero, I need to buy an airplane, I could buy the used or the new of the 737 or the A320. We think that over a 12-year lifespan, that it would be more cost beneficial to buy the used.
That's really interesting because that's really not going to help the whole net zero thing at the end of the day, right?
You're right. And so, look, I think part of, the net zero and ESG considerations for sure are some of the factors that continue to keep demand for new airplanes high. One of the points we make in this piece of research is that we're concerned that if rates stay high, airlines exhaust some of this cash they have on their balance sheet that they, again, socked away because of the pandemic, and now it's sitting there in the balance sheet at really good rates. They secured at really good rates. If they exhaust that cash and rates haven't fallen by the time they exhaust that cash, airlines globally may be reluctant to keep adding to new fleet given the much cheaper price of used and the price of fuel and efficiency differentials.
If that happens, what's the knock-on effect of that? And I guess I'm thinking of it from a passenger point of view.
So, from a passenger point of view, I don't know that people would realize that much of a difference in their travel. I think a 737-800 NG would look very similar to the MAX. Same thing on the Airbus product.
Okay.
And now, obviously your carbon footprint goes up, right, as a traveler if you're flying in the older aircraft. Look, for the airlines, I think it's just a very economic decision, right? At some point, they want to be ESG friendly. Mm-hmm. They want to be refreshing fleets. They like to be fuel efficient because fuel efficiency obviously helps at times when fuel prices spike. But we did our analysis at $3 fuel. We used Gulf Coast Jet, which is a benchmark in the industry, and $3 is higher than the average since '08. The average since '08 is sort of in the mid-2s. So even our analysis from an efficiency standpoint would indicate that the fuel efficiency gains we're getting on these airplanes now are higher than average, and so that would even upset this differential even more. That would even, push things sort of squarely towards the used. So I think as a traveler, there's not a big difference in the airplanes.
So I have to wonder though, if we walk it further out, so let's go 7 years down the road, if you get a used jet, I'm assuming that's not going to have the same lifespan as a new one. So at some point they're going to be forced into a replacement cycle, and do they get screwed then later on? That
is, if you're a going concern airline, you are sort of constantly refreshing your fleet. And so, you're going to end up having to buy new sooner or later. I guess just the question becomes, how soon do you refresh that fleet, and how long do you push out that decision? How long can you stretch it? And when we look at the used market right now for these airplanes, that A320 and 737 last generation, there's 300 to 400 of these airplanes sitting in the marketplace that are less than 20 years old, right? So we typically think of an airframe as being good for maybe 30 years. Mm-hmm. So they probably have this 12 or 15-year lifespan they need. And you're right. Again, airlines always have to refresh. The question is, how soon do you put an older airplane down, maybe younger than the 30 years, because you want to get to more fuel efficient and more ESG friendly? You
have to wonder, if you have 10 years left, minimum, at one of these used planes, the new ones you're going to get in 10 years, their fuel efficiency is going to be that much better.
Well, so what happens is we get these big step-ups in fuel efficiency around the time that new engine technology comes out. And the Neo and the Max are powered by the latest engine technology. So I would think that the manufacturers will get you incremental fuel gains on those engines, a couple percent, maybe a year. So maybe in 10 years, you'd get 10% additional fuel efficiency out of this existing engine. The next big step change in fuel efficiency will be in 2035 when the engine manufacturers come out with the next generation engines that should be more efficient.
I see. So you need to wait a little bit longer. Really cool stuff. I learned a lot there, George. Thanks a lot. George Ferguson. He's Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. All right, coming up on the program, we'll talk about the chances of a spot Bitcoin ETF this year. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Each and every week, we're going to be here at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. The main news this week that just rocked the crypto market is the chance that the SEC could approve spot Bitcoin ETF this year. Those chances have now risen 75% following Grayscale's court win this week. The odds by the end of 2024 reach 95%. Those are pretty decent odds. Joining us now for more, we want to welcome Bloomberg Intelligence Senior ETF Analyst James Seyffart. Hey, James, okay, first of all, what actually happened this week? Let's just start with some basics.
Yeah, so, I mean, from a high level, it was kind of a monumental decision here from the D.C. Circuit Court of Appeals. They shot down every level of argument, every point that the SEC made to deny spot Bitcoin ETFs over the last few years, particularly since we saw the approval of Bitcoin futures ETFs in the fall of 2021. And basically what this decision comes down to, or this opinion from the court comes down to, is that basically said the SEC can't be worried about fraud and manipulation in the underlying spot market and Bitcoin in general, while allowing Bitcoin futures ETFs to exist. In June, they just approved 2x leverage Bitcoin futures. So this opinion comes down very harshly, if I might add, on the SEC for basically treating like situations differently. They basically said you can't allow Bitcoin futures ETFs to exist, say you're worried about fraud and manipulation, and use that as a reason for spot Bitcoin ETF denial. So it's basically been vacated. That denial of converting Grayscale's GBTC to an ETF has been vacated, and now it's back to the SEC.
Okay, but it doesn't mean that all of a sudden there's a spot Bitcoin ETF. So the SEC has 45 days to do something?
Yeah, so technically they even have longer to go to try and appeal to the Supreme Court, but that's almost certainly not going to happen in our view. But they do have 45 days to file an en banc hearing. So basically the way this court works is it's a panel of 3 judges. They made a decision. This decision was, I mentioned the strong language, is also unanimous. It was a 3-0 decision in favor of Grayscale. But what the SEC could do is if they really wanted to appeal it, they could do something called an en banc hearing, which would be, rather than 3 judges, we want all the judges on this court to take a look at this, and it would be 17 judges. But again, that request would have to be granted, and even then, we still think that Grayscale would come out ahead.
Okay, so if Grayscale comes out ahead, what's the timing, do you think, for something like this? And do other ETFs that are also in the pipeline for a spot Bitcoin kind of go quickly at the same time now?
Yeah, so our stance here from the get-go has been that a bunch are going to go at the same time. We don't think the SEC is going to play kingmaker here. They're not going to pick winners and losers. So if they end up approving spot Bitcoin ETFs, we think there's going to be a group of them, or maybe all of them. There's 11 of them in total, including Grayscale. As far as timelines go, it's not super clear, right? Usually I've read some of these reports leading up to this, and the SEC will give clear guidelines on what needs to happen next. That didn't really happen here. It basically said this order is vacated and sent it back to the SEC. So we're waiting for something from the SEC to say, like, what happened next? Is Grayscale going to have to enter this process, which is a 240-day-long process, all over again? Is there going to be some other process? And honestly, Grayscale, Michael Sonnenschein, you had him on TV this week. He said he doesn't know what's next. Him and his lawyers aren't sure. So they're waiting to hear from the SEC, who is likely talking with the courts to figure out what the next steps are here.
Yeah,
so we're waiting, watching.
He definitely answered that question at least 47 times and basically was like, we don't know. We will do what they tell us to do in terms of the refiling. Is there anything that Grayscale can do to kind of get ahead of any of this?
I don't know how they would get ahead of it. I mean, I would hope that they're fully ready and able to convert this thing into an ETF. There's a lot of things that have to happen on the back end of plumbing when you're setting it up an ETF. And this would be the first one that use spot Bitcoin markets, right? So there's a lot of issues on the back end. So hopefully all that's sorted out. But really what Grayscale's probably worried about is they want to make sure that if this is approved, the spot Bitcoin ETF is approved, they don't want to be way behind these other issuers like BlackRock and Invesco and Fidelity that have filed. They probably want to make sure that they're going out at the same time or right around the same time. So I think that's what they're focused on, assuming these approvals happen. Again, 75% odds this year and much higher next year.
All right, let's just pretend like it does. What kind of money flow do you think you're going to see into these kind of ETFs? Like, how popular do you think they're going to be?
So it's funny. We try to look at other examples of this. So the best closest example we could find in history was when gold ETFs were launched. A ton of demand. But the difference here is that, like, that was opening demand for retail. If you wanted to access the gold in your brokerage account, most people just use gold miners stocks, gold miner funds. There was no way to really do it. Here, if anyone really wants Bitcoin, they can kind of get it using Coinbase and other assets, right? The one thing that it does open the avenue for is a lot of these institutions, if there's pensions that are interested in this, or actual mutual funds and other ETFs, right? They're restricted from holding spot Bitcoin. That's what these ETFs are trying to do. So this would open the avenue because a spot Bitcoin ETF is a security. So if your mandate is you have to invest in fixed income securities or bonds, what have you, this would become a security and you could then invest in Bitcoin. Now, what is the demand there? We're not really sure. We do think this could be the largest ETF launch in history, which ironically, the largest up to this point is BITO, which is the Bitcoin futures ETF that launched in October of 2021. And that one got to $1 billion in 2 days. And the prior record was when GLD, the first gold ETF, launched in 2004. And that took 3 days to get to $1 billion. Now, that said, $1 billion back in the early 2000s is very different from $1 billion today. But we think it could do it in a day, potentially, particularly because there's so much money in futures ETFs and these Grayscale products that could potentially move around.
Also, I think it's interesting, like, what would the purpose of this Bitcoin ETF serve in your portfolio? So gold has always been very clear, right? Like a safe haven trade, anti-dollar trade, inflation trade, etc. And I'm not entirely clear as to what the purpose of a Bitcoin ETF serves. I'm sure there is one, but I don't know what it is.
Yeah, so a lot of people like to point out how volatile Bitcoin can be.
Well, I mean, it tracks tech, and then at some point it was tracking gold. Like, it's hard to get a read on that.
Yeah, the correlation is pretty low. Over shorter time periods, like you mentioned, it was very close to the Qs. Like Bitcoin was basically trading in line. You overlaid them. They were on top of each other. But over longer time periods, 1 year, 3 year, 5 year, even 10 year, for the most part, even small allocations drastically increase the Sharpe ratio. Obviously, that's historical analysis, not indicative of future returns. Not to mention, if you're an advisor and you have clients who are just saying either they have crypto themselves, they hold Bitcoin on their own, and it's not under your basically umbrella to control what your clients are doing, you would much prefer to be able to choose what that allocation looks like, control the allocation, rebalance to it. There's a lot of benefits that would come to advisors and institutions being able to access this. But again, like I said, most retail people, if they truly want exposure, they already have it. But it does make sense in the overall level of a portfolio in smaller percentages.
Great stuff. Learned a ton. Super appreciate James Seyffart. He is Bloomberg Intelligence Senior ETF Analyst. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele. This is Bloomberg. Now let's turn to the credit market, this time specifically in Europe. You continue to see rising rates out of the ECB, and even if they pause rate hikes here, pausing around 3.75 or 4% for a long time is still going to have an impact on the credit space. So for more, we're joined now by Bloomberg Intelligence Chief European Credit Strategist Mahesh Bhimalingam. Mahesh, first of all, are we seeing any real distress so far in the credit market because of the ECB hikes?
We first need to quantify how you measure distress. So the typical way to measure distress in the credit markets is what percentage of the high yield index is trading under 60, right? Mm-hmm. So in case of default, your recovery is going to be 40. You tend to, get you lose 60 and so on. So the distress rate right now is running at about 4.8%. Now, just to quantify it, it is pretty close to the peak that we've seen. The peak was around 5.2% in October 2022. This is like peak Putin, significantly high commodity prices and rampant inflation, right, at that time. So we're getting there in terms of distress. The thing is distress translating into defaults? That is the key question, right?
Is it?
So, So in Europe, unlike the US, by the way, filing for bankruptcy here is very, very difficult because there tends to be, people coming in, including the government, getting involved, and then everybody sits around the table because there are jobs to protect.
Of course,
right?
yeah.
So,
and there are different union rules, and there's a different employment structure, 100%.
Significantly stronger union rules and labor laws here mean that the governments also get involved, particularly in the continent, less so in the UK. So what you tend to have is a lot of talk, a lot of voluntary restructuring.
Mm-hmm.
So you tend not to get to direct defaults. The default count tends to be very low. So just to give you an idea, in 23 months, we had one default in the first quarter and then another default in the second quarter, just two this year.
Mahesh, does that just mean you have a bunch of zombie companies walking around that should be defaulted but are just sort of saved because you need to restructure? Like, is the result of that a good thing?
Very good question. So how much can you say is the market comprising of zombie companies? So we've done this analysis, and the way to look at it is, we've done by price, right? What is the market pricing? We know 4.8%. So in terms of credit quality zombie, you can say how much of the market is triple C, that is about 27 billion, like just 50 bonds. How much of it is double C to D? There are just 9 bonds, 3.7 billion. So if you look at triple C minus double C and single C, there are just 6 companies, a total of about 9 billion. And even if all of them default right now, today, you're going to get a default rate of 2%.
So that's really perspective-wise.
Yeah. So in terms of zombie companies, I can count 6. We actually have the names published, by the way.
Okay. So what are they? Which companies?
So we got Casino. Yes. So to your point, it is a zombie company, but the government got involved. They got a voluntary conciliation. So that is a single C-rated company. Then there is Metal Corp. Then there is the Swedish real estate company SBB. Then there is Adler Group. By the way, Adler Group used to be single C. It got upgraded to triple C minus due to the restructuring that they have done. Then there are 2 very small triple C minus companies. So that brings you to about 9 billion total.
So based on that, how do you make money as an investor in this space? Like, knowing that there's not a lot of zombie companies, but there is this government backstop. What's a fair value?
So our view has always been that European high yield will never behave like US high yield in terms of defaults. Mm-hmm. And as a result, I think this rampant bearishness and default wave is coming is now going to happen. So we had a very positive view on European high yield, even relative to Euro investment grade, and definitely versus Euro rates. So, if you are a traditional real money fund, being long only high yield is not a bad trade at all. And it's playing out very well, by the way. So years to date, it is done 4.85%.
So does it matter what kind of sectors we're also talking about or regionally? What are we noticing in terms of that divide?
More than geography, within high yield, you tend to have sector, dispersion. Communications, which is all this telecom, cable, etc., that tends to do very well. It tends to be defensive. Fundamentals have improved, actually, in the second quarter earnings. What tends to be negative are the consumer cyclical, basic industry. Those sort of companies, fundamentals have deteriorated in the second quarter earnings that has just finished.
So does that mean that basically the ECB can keep hiking and it won't break stuff?
Definitely the one hike is slowly happening. There might be a need to do one more. I mean, you saw the recent Spanish inflation, which is again above expectations. So the ECB definitely has more leeway if it just looks at credit. But obviously the ECB is more wedded to what is happening to government finances rather than corporate finances. So government finances are getting a bit stretched, right? So that probably might make them stop at 1 rather than 2.
Yeah. Okay. Fair enough. Really great. Really interesting. I hadn't thought about how the government sort of plays into that whole scenario. But again, like zombie companies, 2%. It's really not that bad. All right. Mahesh Bhimalingam joining us, Bloomberg Intelligence Chief European Credit Strategist. That wraps it up for this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. Remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele. Stay with us. Today's top stories and global business headlines are coming up right now.